There is a massive misconception in the financial world that has persisted for years and caused countless investors to slowly melt away their capital. Most people view markets as a branch of science with exact rules like physics or chemistry, testable in a laboratory environment. We assume that if we build a better mathematical model, if we draw those famous lines on the chart more accurately and neatly, we can beat the market. However, according to López de Prado, one of the greatest geniuses of modern financial data science, this approach is a fatal flaw right from the start. Why? Because financial markets are not stationary. They are a constantly changing, evolving chaos that adapts to new rules and actors and, most importantly, progresses on a single timeline of reality. It is impossible to go back in time and retest the same market conditions with a different scenario. All we have is a single, already experienced instance of the past. Trying to predict the future with absolute certainty by merely looking at this single instance is the biggest mistake one can make in the world of financial machine learning and technical analysis. When machine learning first entered finance, everyone shared a common dream. We will collect more data, write more powerful algorithms, and achieve much higher Sharpe ratios. But the real world did not resemble a laboratory environment, and the result was a colossal disappointment. Most models collapsed the moment they went live in the market. Billion-dollar funds shut down, and those magnificent strategies that looked perfect on paper vanished in seconds against the ruthless dynamics of the real market. Prado makes a very critical observation here that should be etched into all our minds. Machine learning is not a magic wand that can solve finance on its own. If you use it incorrectly, you will only magnify the scale and speed of your mistakes. In other words, you will lose money much faster and in a more algorithmic way than before. So, what exactly is the problem with classical technical analysis? Prado actually does not completely throw classical technical analysis in the trash. What he objects to is the traditional way technical analysis is used, and he rejects this unequivocally. Classical technical analysis is highly subjective. It is almost impossible to test scientifically, and is extremely prone to falling into the trap of over-optimization, namely overfitting, which is our biggest enemy in machine learning. When you look at the screen and see a head and shoulders pattern or a flawless pennant, what is actually happening at that moment is not the market giving you a message. It is merely your brain's attempt to find a familiar meaning in that complex data set. You cannot find a mathematical advantage, a statistical edge in the market just by reading charts and looking at the shapes the price has drawn in the past. However, the point where Prado proves to be a genius begins exactly here. He does not refuse to use technical analysis data. On the contrary, he chooses to stop interpreting this data for directional forecasting and instead models it. In his approach, technical analysis is not a signaling mechanism. Technical analysis is a feature, a source of features in data science terms. None of your beloved RSI, ADX, ATR, Bollinger Bands, momentum, or volume oscillators that you add to your screen can directly generate a buy or sell signal for you. These are merely mathematical inputs that define the current state, volatility, and trend strength of the market. They are the inputs that your model will feed on and process. Classical technical analysis assumes that when a pattern or formation occurs, the price will definitely go in a certain direction. Prado, on the other hand, focuses on probability distributions instead of the concept of patterns. Instead of saying this formation works and the price will rise from a deterministic point of view, he asks, what is the probability distribution of the outcomes in the 10,000 past instances where this market structure occurred? This difference is the fundamental mindset shift that transforms technical analysis from fortune-telling done by looking at a screen into a statistical science with strict rules. One of the clearest and most staggering places where this mindset shift is seen is the perspective on the concept of time. What does a classical trader do when they open their screen in the morning? They immediately set the data period to 5 minutes, 1 hour, or 1 day and start watching the candles. According to Prado, this time-based analysis method is completely meaningless, even dangerous, because markets do not move by the ticking of a clock. Markets move with transactions, money flow, and information dropping into the market. Think about it. Can a 1-hour candle formed in a midnight session where no trades occur and volume approaches zero have the same informational weight as a 1-hour candle formed in those crazy seconds when non-farm payroll data or inflation figures are announced? Of course not. Time-based candles are a curtain of noise that hides the true structure of the market and distorts the data. Instead, Prado advocates for the event-based analysis method, where the market flows not with the clock but with information. By using volume bars or dollar bars, he restructures the data beyond time, according to the speed of the traded money and information. In this way, the real signal in the market becomes clear, statistical properties become much more stable, and the algorithms you build begin to learn the true microstructure of the market. This change is the very transition from a narrow indicator-centric world to a broad market structure-centric world. Order flow, liquidity dynamics, and the current microstructure of the market have now replaced lagging moving averages. Let's say we freed the data from the deceptive shackles of time zones. But is this data itself ready to be fed to the model? At this point, most people just throw the price data directly into the machine learning model and expect the system to magically solve it. However, here lies one of the biggest dilemmas of financial data science: the relentless war between stationarity and memory. Raw price data contains all the past memory, crises, and trends of the market, but it is not statistically stationary, meaning its mean and variance change over time. If you feed this raw data to an algorithm, your algorithm will blow up before long. Conversely, if you take the price and convert it into logarithmic returns, as classical financiers have done for years, yes, the data becomes stationary and all statistical tests work perfectly. But this time, you have completely destroyed that incredibly valuable long-term memory within the price, the very character of the market. Your model remembers yesterday but forgets last year. Prado solves this huge dilemma with a magnificent mathematical method he calls fractional differentiation. Thanks to this method, the data is transformed only just enough to become stationary, meaning at a minimum level, and that invaluable market memory within the price is preserved to the maximum extent. Now you have a flawless dataset that is both stable enough for machine learning models to understand and has not forgotten the historical movement characteristics of the market. Now we come to the point where Prado truly demolishes classical technical analysis and makes the biggest difference: the labeling process. In classical techniques, the goal is always very simple: generating a signal. Buy when the price crosses the moving average upwards, sell when it crosses downwards. The target here is always the effort to know whether the price will go up or down in the next step. However, as you can appreciate, this is an extremely primitive approach that completely ignores the instantaneous volatility of the market, the risk you carry, and the duration you stay in that position. Prado fundamentally changes this primitive method with the triple barrier method. He teaches the model not just the direction of the price, but to define the ultimate outcome. In this method, you draw 3 invisible barriers around the price. The upper barrier is your take-profit level, the lower barrier is your stop-loss level, and the vertical barrier is the maximum time limit you can stay in that position. The algorithm now thinks multidimensionally. It doesn't engage in a meaningless prediction like, where will the price be in 5 days? Instead, it calculates the probabilities for the question: in the current volatility environment, will the price hit the take-profit barrier, the stop-loss barrier, or the time limit first? This is an extraordinary shift because you have taught the model not only the direction of the market, but also risk and reward behavior, the path dependency of trades, and the volatility dynamics of the market. Remember, the labeling process is the sole thing that determines what your model will learn, and a wrong objective function will instantly turn even the most perfect algorithm into garbage. Yet, despite all these correct data preparation and perfect labeling steps, that famous trap that traders fall into the most and that Prado attacks the hardest still stands before us: the backtest illusion. There is a very common and dangerous belief in classical technical analysis: if a strategy made a lot of money on past data, it will make money in the future too. Prado shatters this thought. If you have a powerful enough computer and test thousands of different indicator combinations on the same historical dataset, finding a perfectly working, massively profitable strategy purely by chance is not a skill, but a mathematical certainty. This is called overfitting. That strategy you found with a magnificent Sharpe ratio, with a chart going straight up, does not appear successful because it captured a real dynamic of the market. It appears successful only because you tortured that data and tested it until you got the result you wanted. When companies hire dozens of quant analysts and say, "Find me alpha," everyone runs the same tests millions of times on the same historical data, and as a result, we enter that endless cycle called the Sisyphus paradigm. False positive results are constantly generated. Strategies that will collapse in their first week when they hit the real market shine like works of genius in backtest reports. To destroy this illusion, Prado developed the concept of the deflated Sharpe ratio. This metric ruthlessly takes into account the thousands of tests you performed, the length of the data, and the correlation between models, and it slaps you in the face with the reality of whether the Sharpe ratio you found is the product of true genius or just a statistical fluke. Another invisible leg of this backtest illusion is the errors in the cross-validation method frequently used in machine learning. The cross-validation method used in standard data science assumes that the data you have is independent of each other. However, in financial time series, the data points are glued together. Yesterday's data is the cause of today's data. In tests conducted with classical methods, data leakage occurs between the training set and the test set. Your model has already secretly seen the future it will be tested on during the training phase, as if it had stolen the exam questions in advance. That is why the results always come out great. To prevent this, Prado develops much stricter methods. These methods surgically cut out that temporal bond and overlapping data between the training and test sets. It prevents data leakage and reveals in its barest, most ruthless form what the model will do in the real world when faced with crisis data it has never seen in its life. Instead of weak traditional tests, he tests the true limits of the strategy with Monte Carlo simulations that generate thousands of alternative historical scenarios. And now we come to the most institutional, most elite level of the business, the meta-layer mindset. A normal trader looks at the screen, sees two moving averages cross, their model generates a signal, and they excitedly enter a trade with that signal. Prado, however, does not think so simply. He builds another model on top of the model. He calls this meta-labeling. Your primary model generates a signal regarding the market direction, just like in traditional technical analysis. But this signal is not immediately sent to the market as an order. A second machine learning model, the meta model, steps in. The task of this second model is not to predict the direction of the price. Its only job is to calculate the probability of the primary model's signal being correct, meaning how reliable that signal is. If the meta model finds the success probability of the primary signal to be low, it completely vetoes that trade or reduces the position size to be entered to a minimum. If the confidence in the signal is very high, it increases the bet size and becomes aggressive. This approach leaves to machine learning not just when to enter a trade, but how capital, the thing that actually makes money in the market, is managed. While classical analysis focuses only on where to buy and where to sell, Prado places risk, position sizing, and capital control right at the heart of the system. In the market, correlations always break. Assets that moved hand in hand in the past suddenly detach from each other in moments of crisis. Therefore, Prado criticizes the problem of hundreds of fake factors running wild in finance and focuses on causality instead of correlation. He argues that any model built without filtering out hidden variables is a statistical mirage, that it will deceive you like an oasis seen in the desert. Even in portfolio optimization, Prado pushes classical methods aside with the back of his hand. Instead of traditional portfolio theory, which is highly sensitive to market noise and unstable, he uses the machine learning-based hierarchical risk parity model. Thanks to this method, without remaining dependent on the flawed and fragile matrices of the past, he builds much more solid portfolios that stand like a wall against crises by clustering the true structural relationships of assets with one another. To sum up, what López de Prado is telling us is not actually a standard technical analysis or coding lesson. This is literally a paradigm shift. If you are still looking for the perfect formation in the market, if you think you will get rich the day you find that magic indicator with the right parameters, I am sorry, but you are bound to be a permanent member of the Losers Club. Machine learning algorithms are so powerful that they always find a pattern in the data, even if there is no real pattern there. That is the greatest danger. Prado's philosophy teaches us first and foremost to define the problem correctly. Our main question should not be, how do I make money from the market? But how do I avoid producing false results and deceiving myself? Being a successful trader is not about finding a single great strategy and leaning back. Success is about building a flawless data pipeline, processing the right features like a marvel of engineering, creating leak-free models, and running a ruthless validation process. Success is not a search for a setup on the screen morning and night, but building a data-driven factory that works like clockwork from start to finish. Technical analysis will never, ever generate absolute signals for you, but if you position it correctly, it provides you with the most valuable raw material to run this massive factory, namely the correct data. Remember, beating the market is not a moment of discovery experienced by chance, but the natural outcome of a scientifically and ruthlessly built production system founded on solid foundations. Thank you for listening, wishing you to stay rational in the markets.